So anyway, earlier this week I was looking for some information in relation to Virgin Airlines because I teach the postgrad equivalent of ABC, and I just know from experience there's actually Virgin Airlines, some of you guys may have been aware of this, have acquired Tiger Airways Australia. So Tiger in Australia is actually now owned by Virgin. Now there's some question marks whether it's a joint venture or sort of joint arrangement or a consolidation. We still actually don't know at this point. It sounds like it's more of a joint arrangement, but I was looking for some information about them and some of the announcements in relation to it for the class. And I actually came up with some other information about Virgin, which this happened last week. So there was an ASX release on the 9th of May. Virgin Australia Holdings Limited has today settled on the sale and leaseback of its Brisbane-based office located at somewhere in Queensland to Charter Hall Direct Property Management Limited. Virgin Australia confirms that there will be no changes to the day-to-day operations of the property and that it remains committed to Brisbane as its main base and operational headquarters. Talk about the various people advising Virgin on the transaction, and that was it. It was like sort of a 7-page release just saying that's happened. So the issue that we have with sale and leasebacks, what they actually are to begin with is, as you see up there, is has a sale actually occurred? So casting your minds back, week 2. Week 2, when the hell was that? It was ages ago. Revenue, provision of services, sales of goods. There are criteria for when you can recognise a sale, when you can recognise the sale of goods versus provision of services. Some of them around the reliability of the amount are similar, but when you have a provision of a service, the thing that you're looking for is percentage complete. Do you know how much of the job that you've performed? When you're looking at a sale of a good, what is one of the critical things that you're looking at then? So if I sell this bottle to someone here, what is the thing that has to happen for me to be able to record this as a sale?
Transaction.
Yeah, there's got to be a transaction. There's...
Transfer of ownership?
It's not necessarily ownership, which is the critical thing they talk about there. I mean, obviously ownership is like, yeah, it's sort of getting at this control issue. You have sort of the risks and rewards of ownership transferred. Have you basically transferred that across? So let's think about that. So what's your name? Full. So I sell this bottle of water. I don't know why you're buying it from. Oh, look, it's $15. So I sell this to Fung for $10. I take it. I sell it to her, then I lease it back from her. Now, if I have leased it from her in a finance lease, who has control?
You.
I do. So if I have control, did a sale ever really happen? Kind of like, if a tree fell in the woods and no one's there to hear it, did it really happen? Did I ever really sell it? Has control actually passed to you?
Yeah, at some point.
But it's not like Virgin Australia's that headquarters in Brisbane. It's not like they sort of picked it up, gave it to you, and then sort of moved all they moved all their stuff out, then went, okay, now you can move all your stuff back in. It's like people just went to work as normal, and just suddenly they don't technically own the thing anymore. So did I ever really sell it? From an accounting point of view, I suppose from a legal point of view, I did sell it, but from an accounting point of view, did I ever really sell it? No, so if it's a finance lease back, I've got control. It's like control is gone, control has come back. It's all exactly the same time. I've never really sold it. If I sell it to you and then, I'll just get you to hold it, and then I lease it back from you for the next day because I need something to hold my water while I finish up class, and then you get it back at the end of the day, you have control. So that would look like a sale has happened. So the key thing there is kind of has control, like are we looking at this idea of risk and rewards of ownership, has it actually passed? Because I would hazard, and I don't know the details other than what I've read to you of that Virgin sale and leaseback, these commonly get used for financing transactions. Because think about what's happened. I've sold this to you for $10, or 20 or whatever we agreed, $10. I then lease it back. So what do I now have?
Cash.
I now have $10. Do I still have my water bottle? I still have my water bottle. So what's changed? Apart from the 2 seconds before I did this, I still have my water bottle and I now have $10 cash. They use it to basically finance operations, and they use it and secure it against the asset which they're doing it. It's not that dissimilar to reverse mortgages. So if we're starting to see some of that happen, and maybe some of your parents might be doing this. They have property assets with very little debt, if any debt against it, and they say, well, we want to finance some things to be able to kind of go off and spend your inheritance, and they finance it, they go off and borrow against that asset, and it's not like they've moved out of the property. They still live there. It's just they've borrowed against that particular asset. And that's pretty much what's happening here. Governments do this too. A number of state governments in the US have done it. I think New South Wales did it a little while ago as well. Like it is something which happens. So how we account for this? If it is a finance leaseback, and this was on my books at $6, and I sold it for $10. I would normally show, if it was a normal sale, I'd show a gain of $4. I don't show that gain straight away. If I'm going to lease it for the next 4 years, I would show $1 of profit each year for the next 4 years. I would slowly release that profit out. You'd see the sale happen, you'd see the asset disappear, then you'd see it come back on as a lease asset. But the important thing is the profit from the sale never really occurred. With an operating leaseback, this is where the sale has actually happened, from an accounting point of view, because you have actually sold it, control has been passed over. What the important points that we're looking at is, how does the sale price relate to the fair value, relate to the carrying value? So let's have a look at this. So if the sale price is at fair value, so let's just say the carrying value of my water bottle is $6, that the fair value of it for sale is 10. Now if I sell it for 10, so that first situation, its sale price is at fair value. So I've got a water bottle, it's been depreciated on my books, it's at $6. I sell it to Fung for $10. She could go to any one of you guys that all have water bottles in the marketplace, exactly the same thing. She could get it for $10 anywhere else. That's all good. That is as legitimate a sale as you could get. I show the profit like normal. So I would show that gain as $4 and that would be fine. If the sale price was at $9, I have sold it to her for less than what she could buy somewhere else. So it makes sense for her to buy it from me because she's buying it for less than what she could get elsewhere. So I mean, it's rational for her to do it. It's not really that rational for me to do it, because why would I sell something for $9 when I could sell it for 10? Because it's not like I wouldn't get a sale, the market would bear that. So because you're not showing additional profit, you do get to show that gain. So the profit or loss is recognized. But I think if you look at the details, and it's not something we're going to be worried about, but if you look at the details, I think you need to be careful of, have there been other sort of benefits that came out of this arrangement? Like, have you given me a better deal on the lease that's coming back? Because maybe that's why you bought it from me for a lower price. Maybe that we worked out something else where that kind of works out nicely elsewhere. So, but at least for this game, we're not so worried about it if there's nothing else untoward going on, because it's not showing a profit higher than fair value. The next situation is different. The next situation is, I have sold it for $12 to her. Now that starts to become a bit problematic, because why would you buy it from me for $12 if you could buy exactly the same asset from any one of you guys in the market for 10? that's starting to look like we may be playing some sort of game there. So that would not be a gain of $6. You pick up the gain of $4, and the excess over the fair value is deferred and amortized. So the bit which is kind of the legitimate gain you're allowed to show, and then I'm not saying this isn't a legitimate gain. I mean, there may well be good reasons why this has happened, but they're saying you don't get to show all of that up front. You get to show that gain, and then you defer that out. And then the last thing that we have is if the carrying value is greater than the fair value. So if we have a carrying value of $6 and the fair value is $2, without even worried about leases, if you see something like that, what's likely to be the situation? So if I'm holding this on my books for $6 and its fair value is $2, what's likely to be the case?
Impaired.
Yeah, it's likely to be that it's impaired. And that's why when you look at the bottom of that page, if the carrying value is greater than the fair value, the difference between the carrying value and the fair value is recognized as a loss immediately. So you're picking up that loss of $4, and then you then deal with whatever the sale is after that. So if you sold it for $2, you're not showing any profit on that sale, and you've incurred that loss of $4. So with leasebacks, if it is a finance leaseback, has the sale really happened, and then you're looking at any gain on that sale has been amortized out. If it is an operating leaseback, you're looking at what you sold it for and in comparison to the fair value. If you're looking also at a situation with the carrying value, it is important to keep an eye on that too. But on that note, I think that's all she wrote. Welcome to the laptop. So in summary, have an idea what some of the issues around leases and why they're problematic, what the alternative methods for accounting for leases are, so this idea of an operating and a finance lease, why companies prefer to use operating leases. If they could, they're not going to be able to account for all of them like that, but there is a preference to use operating leases instead. So why is that the case? And I suppose as an add-on to that, is it going to be a stronger incentive if there's contractual things in place versus if it's a contractual reason versus if it's a decision-making reason? Think about what information you can see, what information you can access. Is it in the financials? Is it in the notes? Does that change things? Understand how the regulation narrows the accounting policy choice. We've applied it. And think about the regulations which are coming up. And just as a very final point, we've got about 20 minutes, and I'm not going to use that. I'm going to use about 2. There's a problem. I think we've identified what that problem is with the current set of standards. There's a problem because companies are trying to use operating leases more than finance leases. So the regulators have come out and said, this is what we propose to do with it. And without getting into the detail of it, at the moment there's an arbitrary point in where they draw the difference between a finance lease and an operating lease. They've pretty much gone, let's get rid of that arbitrary point, and basically they've inserted a different arbitrary point and also on a slightly different way of doing things. Now, there's some good aspects to the proposal. It also basically shifts the problem just to another particular area. Like they've just changed where the problem sits. And I don't know if it necessarily helps the situation, but if you think about any regulatory intervention, the reason why people intervene in something is they're trying to solve a perceived problem. Think about recently the lockouts in New South Wales. There was a perceived, I don't actually think that's just a perceived problem. That is a problem. But there's a problem there which they're trying to solve, which is alcohol-fueled violence. And they went, let's create this area in Sydney where certain restrictions apply. And the people, the King's Cross hoteliers are saying, well, that's just going to shift the problem. They're just going to go to places outside the zone, so to Pyrmont, to various other places, to, it was kind of interesting that Barangaroo was somehow excluded from that zone. You know, we won't get into vested interest in there, but I think, you know, it's sort of interesting that that little part of Sydney didn't sort of feature in that area. But is this argument that if you create regulation, you're just shifting the problem and you're just potentially creating another problem by solving the first problem. Now, does that mean you just don't do anything? I don't think that's a good answer either. But they're trying to solve the problem with the leases. I don't necessarily know if their answer is the one that we need, but they're trying to at least do something. So, something to think about. There you go.